You're welcome back, my dear professional students. So far, we have been able to prepare the statement of profit or loss. And here is our statement of profit or loss. But there is one thing I want you to note, which is the allowance for receivables that we said we should not treat anymore. Let me clean all of this. Okay, where is it? Now, if you remember that we're told that the allowances for receivables are no longer required. And I showed you that these allowances for receivables, they have it here as provisions for receivables. Okay, which is 21,220. Right? And for it to be in the trial balance, that means they will have posted it to the relevant ledger. Okay, and which is usually they will credit this allowance for receivables account called provisions for receivable. They will credit an allowance account which will be transferred to the trade receivables. Okay, and also they will debit an account known as, they could debit the bad debt account. Right? So these provisions for receivables as it is right now, okay, we expect that it should not have been deducted from the trade receivables account. Okay, is the provisions for receivables account that will be deducted, that will be transferred to the trade receivables account. So we are still going to maintain our stand that this amount should be completely omitted. Okay, we should just leave it since they said it is no longer required. It is no longer required in our books, right? So we just take it off. We will not even show it at all in the statement of profit or loss, except if it has been added as part of the irrecoverable debt. And where is our irrecoverable debt? This 14th is not even up to it. Okay, so I'll just advise that we leave it since it is no longer required. So we will not post it into the account, we will not post it as an expense, and we will not go and remove it from the trade receivables account. Okay, that's just the only item. So now what we have left now is for us to prepare the statement of changes in equity before we finally prepare the statement of financial position. So I will prepare the statement of changes in equity. Still Excellent PLC. We already have the name. So we have statements of changes in equity. For the year ended 30 June 2014. So we need to go to the question and see what are the items of equity that we have. And in this question, the items of equity that we have are, I have here my ordinary shares, I have retained earnings, and there was dividend paid that will have been paid from the retained earnings. Ordinary shares, retained earnings, and revaluation surplus. So I will have ordinary share capital. I will have my share capital. I will have my retained earnings. I will have my revaluation surplus. And there is the total as given in the question. So the balance at the beginning of the period, which is the balance brought forward, we just pick the figures from the question And at the beginning of the period, the ordinary shares was 100,000. The retained earnings is 30,000. The revaluation surplus is 8,000. So 130 and 8,000. We have 100,000. 30,000. And 8,000. And the total is 138,000. And since it's a statement of changes in equity, what we want to look at are those items that usually result in changes in these items of equity. Those items that cause them to change or cause them to move. And for the share capital, for it to change, either increase or decrease, there has to be an issue of shares during the period. And they didn't give us any information with respect to that. Okay, so there was no issue of shares. For the retained earnings, what will make it to increase or decrease is the profit for the year will make it to increase, while if there is any dividend paid for that period, we pay it from the dividend. However, before we get to that, there was a prior period adjustment that we did. There was a prior period adjustment when we were determining the opening inventory. If you remember, we adjusted the opening inventory to 13,550, which had a cost of 16,000. That was the first question we worked. This is the opening inventory. Okay. The cost was 16,000, but we got a new value for it as 13,550. So 16,000 minus 13,550, that's 2,450. What that means is that we have understated the closing inventory of the previous period. We have understated the closing inventory. So the closing inventory we used for the previous period was 16,000. And it was this closing inventory that was used to determine the profit, which has been included in the retained earnings. Now, when we want to determine our opening inventory, it has not been reduced. What has happened is that since the closing inventory of the previous period should be the opening inventory of this current period, and now we use 16,000 in the previous period. Okay? But in this current period, we are using it as 13,550. That means in that retained earnings, because this should have been the correct amount for closing inventory in the previous period, but we use 16,000. So that means we have overcharged. Okay? We have increased our closing inventory by 2,450. That is the difference between these two. And remember that the higher your closing inventory, the higher your profit. That means that the profit has been overstated in the previous year by 2,450. So we call that a prior period adjustment. A prior period adjustment, which is 2,450. Okay? It has been overstated in the previous period, so we need to bring it down. So if you deduct 2,450 from this 30,000, brings it down to 27,550. That would be my restated profit. In addition to that, there was profit for the year. And our profit for the year, we determined it as 372,345. 372,345. 372,345. And there was dividend paid. Dividend paid that was given in the correction. Dividend paid that was given in the correction. So what's the dividend paid? The dividend paid was 15,000. Dividend paid is how much? It's 15,000. So we'll have it here as 15,000. We'll have it here as 15,000. Okay? So is there any other item that should affect the there is no other item that should affect it. Okay, let me just go and close my statement of changes in equity. So that will be the balance carried forward. This will remain at 100,000. While this one will be 30,000 minus 2,450, which gave us 27,550, plus 372, 345 minus 15,000. So that gives me 384,895. And the revaluation surplus still remain 8,000. So all the total figure will go there. So if I add 100,000 plus 384,895 plus 8,000, I should get 492,895. Okay. So in the next video, we'll round it up with the preparation of the statement of financial position. So thank you very much. See you in the next video.